There is a law buried in federal code that allows the government to walk into your bank account and convert your cash into stock in a failing institution. Not insurance, not protection. Shares in a collapsing bank. And you don't get a vote. In 2013, the island nation of Cyprus executed the first large-scale modern bail-in. Depositors went to sleep on Friday with money in the bank. When they woke up 2 weeks later, 47.5% of their savings had been converted into shares of a failing bank. By the time that stock finished collapsing, they had lost closer to 80% of everything. That same legal mechanism exists in the United States right now. It's called Orderly Liquidation Authority under Title II of the Dodd-Frank Act. And with 186 regional banks sitting on commercial real estate exposure that exceeds 300% of their capital, the conditions for mass bank failures are already in place. This video will show you exactly how bail-ins work, the legal authority that permits them in America, the specific banks that are over-leveraged right now, and the timeline for when this crisis unfolds. More importantly, I'm going to show you who loses everything when it happens and who walks away untouched. Then, I'll tell you what you need to do in the next 90 days to make sure you're not holding the bag when the system breaks. Let me start with the mechanics. For most of modern banking history, when a bank failed, two outcomes were possible. Either the government let it collapse and depositors lost their money, or the government bailed it out with taxpayer funds to keep it alive. The first option triggers bank runs and economic contagion. The second option creates moral hazard and public fury. After 2008, when the U.S. government spent $700 billion of taxpayer money rescuing Wall Street, the political cost became too high. People protested in the streets. Politicians received death threats. The message was clear. Another taxpayer-funded bailout would not be tolerated. So the financial system needed a new mechanism, a way to rescue failing banks without using public money. The solution they designed is called a bail-in. Here's how it works. When a bank becomes insolvent, instead of the government injecting capital, the government converts your deposits into equity. Your cash becomes shares, you become a shareholder. That might sound neutral until you realize the bank is failing. The stock is worthless. If you had $400,000 in deposits and it is converted to equity in a bank that's collapsing, that equity might be worth $200,000 tomorrow and $50,000 next week. By the time the bank is liquidated or absorbed by a larger institution, your shares might be worth 10 cents on the dollar, and you cannot exit. The moment the bail-in is announced, trading in the bank's stock is halted. You cannot sell. You watch your savings evaporate in real time with no ability to act. The Cyprus case is not theoretical. It's documented proof that this can happen in a Western democracy with a developed financial system. In 2013, Cyprus had two dominant banks, Bank of Cyprus and Laiki Bank. Both institutions were heavily exposed to Greek sovereign debt. When Greece defaulted, the Cypriot banks were left holding worthless bonds. The banks were insolvent. Cyprus requested a bailout from the European Union. The EU refused. They said, "Fix this without taxpayer money." So Cyprus implemented a bail-in. On Friday night, March 15, 2013, the government announced that all deposits above 100,000 euros would be subject to confiscation and conversion. The banks closed. ATMs stopped dispensing cash. You could not access your money. You could not wire it out. For 2 weeks, the financial system was frozen. When the banks reopened, anyone with more than 100,000 euros discovered that 47.5% of the excess had been converted into shares of Bank of Cyprus. If you had 200,000 euros, you now had 105,000 in cash and 95,000 worth of stock. But that stock was nearly worthless. Within months, it had lost 70% of its value. The real loss wasn't 47.5%. It was closer to 80% after accounting for the collapsing share price. Small business owners who kept operating capital in the bank were destroyed. Retirees who held savings and accounts lost everything. It didn't matter that they had done nothing wrong. The government decided their deposits would be sacrificed to recapitalize the banks, and this was legal. The European Union had passed legislation after 2008 that gave member states the authority to execute bail-ins. When Cyprus activated that authority, depositors had no legal recourse. The law permitted it, so it happened. Now, you might assume that was Cyprus, a small island with a dysfunctional financial system. That could never happen in the United States. You would be wrong. The exact same legal framework exists in American federal law. It's in the Dodd-Frank Wall Street Reform and Consumer Protection Act, passed in 2010. Specifically, Title II of Dodd-Frank grants the Federal Deposit Insurance Corporation something called Orderly Liquidation Authority. That's the sanitized name. What it actually authorizes is bail-ins. Let me read the relevant section. Title II, Section 210 grants the FDIC the power to, quote, convert debt or other obligations into equity. In plain language, they can take your deposits, which are legally classified as debt the bank owes you, and convert them into equity, which means stock. This law has been on the books for 15 years. Almost no one knows it exists. It was marketed to the public as a way to prevent future taxpayer-funded bailouts. Technically, that's accurate. There won't be bailouts. There will be bail-ins. The banks still get rescued. You just pay for it instead of the taxpayers. But it gets worse. The FDIC has already war-gamed how they would execute this. In 2012, the FDIC and the Bank of England co-published a paper titled Resolving Globally Active, Systemically Important Financial Institutions. It's publicly available. In that document, they lay out a strategy called the single point of entry approach. Here's how it works. When a major bank fails, the FDIC seizes the parent holding company. They wipe out existing shareholders. Then they convert bondholders and depositors into the new shareholders. The bank continues operating, but under new ownership. Your ownership. Except the bank is still insolvent, so that ownership is worthless. The paper explicitly states that this method will, quote, impose losses on shareholders and unsecured creditors, and that, quote, deposits above the insured limit may be converted to equity. Unsecured creditors means you. Your deposit is an unsecured loan to the bank. They are telling you, in writing, that they will convert it to stock and that you will absorb losses. This is not hidden. This is not conspiracy. This is official policy, published jointly by the FDIC and the Bank of England, explaining exactly how they plan to handle the next banking crisis. They're just using technical language that most people won't parse. So the legal framework is in place. The execution strategy is documented. The next question is, when will they activate it? The answer is, when the next wave of bank failures begins, and that wave is already forming. Right now, 186 regional banks in the United States have commercial real estate exposure greater than 300% of their capital. Let me break that down. Capital is the bank's equity cushion. It's the buffer that absorbs losses. If a bank has $10 billion in capital, it can lose $10 billion before it becomes insolvent. Commercial real estate exposure means loans the bank made to office buildings, shopping malls, hotels, apartment complexes. If those loans default, the bank takes losses. If a bank has $10 billion in capital and $30 billion in commercial real estate loans, the exposure is 300% of capital. That means if just 1/3 of those loans go bad, the bank's capital is wiped out. The bank is insolvent, and 186 banks are in that position right now. Why is this a crisis? Because commercial real estate is collapsing. Office buildings are sitting at 30% vacancy because remote work destroyed demand. Property values have fallen 50% since 2021. But the loans on those properties were originated in 2021 at the old valuations. A building worth $200 million in 2021 is worth $100 million today. But there's a loan on that building for $150 million. The building is underwater. The owner can't refinance because the property doesn't appraise high enough and interest rates have tripled. The owner defaults. The bank forecloses, sells the building for $100 million, and absorbs a $50 million loss. Multiply that scenario across thousands of buildings and hundreds of banks. The losses will be catastrophic. Industry estimates put total commercial real estate losses at $400 to $600 billion across the entire banking system. The 186 regional banks that are overexposed cannot absorb those losses. Their capital will be wiped out. They will fail. When they fail, the FDIC will intervene, and the FDIC does not have the resources to bail them out.
The FDIC Insurance Fund holds $128 billion. Total deposits in the U.S. banking system are $18.5 trillion. That means the FDIC can cover 0.7% of deposits, less than 1%. If just 10 banks fail, each with $20 billion in assets and $10 billion in insured deposits, that's $100 billion the FDIC has to cover. The fund is nearly depleted after 10 failures. We're not talking about 10 failures. We're talking about 186 banks at risk. If even half of them fail, the FDI is out of money. So what happens when the FDIC runs dry? They implement bail-ins. They convert uninsured deposits into equity. The bank stays open. Insured depositors get their money back. Uninsured depositors get stock in a failing bank. The taxpayer doesn't pay anything. Problem solved. Except if you're the uninsured depositor, you're destroyed. Now, who has uninsured deposits? Who has more than $250,000 in a single account? You might think, that's just wealthy people. I'm not affected. Wrong. This hits the middle class harder than you expect. Small business owners keep operating capital in banks. If you run a business with $2 million in annual revenue, you need cash on hand to cover payroll, rent, suppliers. That cash sits in a business checking account. If your account has 400,000 and your bank fails, 250,000 is insured. Third, the other 150,000 gets converted to stock. That stock collapses. You lose 120,000. Your business can't make payroll. You shut down. Retirees who just sold their house have large cash balances temporarily. If you're 70 years old and you sold your home for 600,000, you might keep that money in a bank while you figure out where to invest it. If your bank fails, you get 250,000 back. The other 350,000 becomes stock in a dying bank. That stock is worth 70,000 when liquidated. You lost 280,000. Your retirement is destroyed. Professionals who hold client funds in trust accounts are exposed. If you're a lawyer with 800,000 in a trust account and the bank fails, only 250,000 is insured. The other 550,000 is converted to worthless stock. You owe your clients 800,000. You only have 250,000. You're personally liable for the shortfall. You declare bankruptcy. Your career is over.
Real estate transactions with funds in escrow are at risk. If you sold a property for $1.2 million and the money is in an escrow account waiting to close, and the bank holding that escrow fails before closing, the escrow account gets bailed in. You lose $950,000. The buyer sues. You have no money. You file bankruptcy. These are not hypotheticals. These exact scenarios played out in Cyprus. Real people, real losses, real bankruptcies. The total amount of uninsured deposits in the U.S. banking system is $8.9 trillion. That's the money at risk. That's what will be converted to stock when the crisis hits. Now let me walk you through exactly how this unfolds, step by step, based on the Cyprus precedent and the FDIC's planning documents. Step 1. A regional bank with heavy commercial real estate exposure announces massive losses. Let's say it's a bank with $50 billion in assets. It reports that commercial real estate defaults have cost it $8 billion. The bank's capital is $4 billion. The bank is insolvent by $4 billion. The stock crashes. Depositors panic. Step 2. Depositors attempt to withdraw funds. This is a bank run. Within 48 hours, $10 billion in deposits are pulled. The bank doesn't have $10 billion in cash. The money is loaned out. The bank faces a liquidity crisis. It cannot meet withdrawal demands. Step 3. The bank requests an emergency loan from the Federal Reserve. The Fed reviews the balance sheet and declines. They don't lend to insolvent institutions. The bank is finished. Step 4. The FDIC steps in. On Friday evening, the FDIC announces it's taking control. The bank closes. All branches shut down. Online banking is disabled. You cannot access your account. You cannot transfer money. You're trapped. The FDIC says they're working on a resolution, and the bank will reopen Monday. Step 5. Over the weekend, the FDIC assesses assets and liabilities. Insured deposits total $25 billion. Uninsured deposits total $15 billion. The FDIC doesn't have $25 billion to pay insured depositors immediately, and they're certainly not covering the $15 billion in uninsured deposits. So they implement a bail-in. Step 6. Monday morning, the bank reopens. Insured depositors under $250,000 can access their funds. Uninsured depositors are informed their excess deposits have been converted to equity. If you had $500,000, you now have $250,000 in cash and $250,000 in stock. Step 7. The stock is worthless. The bank is still insolvent. Within weeks, it's sold to J.P. Morgan for 20 cents on the dollar. Your stock, which represented $250,000 in deposits, is now worth $50,000. You lost $200,000. That's the sequence. Once it starts, you cannot stop it. By the time the bank's trouble makes the news, your money is already frozen. Now here's the systemic nightmare. What if this doesn't happen to one bank? What if it happens to 20 banks simultaneously, or 50? Because that's what's coming in 2026 and 2027. $1.5 trillion in commercial real estate loans mature in that window. These loans were originated in 2019 and 2020 when property values were high and interest rates were low. Now property values are down 40% and rates have tripled. Borrowers cannot refinance. They default. Banks take massive losses. If 30% of these loans default, that's $450 billion in losses. If those losses concentrate in the 186 overexposed regional banks, dozens will fail. Not all 186, but maybe 40, maybe 60. And when failures start, depositors at other regional banks panic. If you see news that 3 banks failed this week and depositors lost money in bail-ins, and you bank at a regional institution, what do? You withdraw your money. Everyone does. That causes more failures. It cascades. This is the systemic risk regulators fear. But they're not fixing the problem. They're just hoping it doesn't happen. And if it does, they have a plan. The plan is to use your money to stabilize the system. Now let me tell you who gets destroyed and who escapes. The destroyed. Small business owners with operating cash in banks. You have $400,000 in your business checking account. Your bank fails. You get $250,000 back in 3 weeks. The other $150,000 converts to stock worth $30,000 after liquidation. You can't make payroll. You lay off employees. You close. The destroyed. Retirees with large cash holdings. You're 72. You sold your house for $550,000 and kept it in the bank while looking for a retirement property. Your bank fails. You get $250,000 insured. The other $300,000 becomes stock worth $60,000 after liquidation. You lost $240,000. You can't afford the retirement condo. You move to a cheaper apartment. You go back to work. The destroyed. Professionals holding client funds. You're a lawyer with $800,000 in client trust accounts. The bank fails. Only $250,000 is insured. The other $550,000 is bailed in and becomes worthless. You owe clients $800,000. You have $250,000. You're liable for $550,000. You declare bankruptcy, you lose your license, your career ends. The destroyed real estate investors with escrow accounts. You sold a property for $1.2 million. The funds are in escrow waiting to close. The escrow bank fails before closing. The account is bailed in. You lose $950,000 of the $1.2 million. The buyer sues. You have no money. You file bankruptcy. These aren't hypotheticals. These exact patterns happened in Cyprus. Now, who escapes? The ultra-wealthy escape because they don't keep cash in banks. If you have $50 million, it's not in a checking account. It's in treasury securities, money market funds, brokerage accounts, offshore structures, trusts. Your wealth is diversified across instruments immune to bail-ins. You're fine. Large corporations escape because they use cash management systems that automatically sweep excess balances into insured accounts across multiple banks or into treasury bills. If a corporation has $10 billion in cash, it's not in one account. It's distributed across hundreds of protected structures. They're fine. Government entities escape because government deposits often receive full insurance regardless of amount. If your city has $50 million in tax revenue in a bank account and the bank fails, the city is made whole even though it exceeds $250,000. Special rules for government. They're fine. The people who get destroyed are the ones in the middle, the people who worked hard, saved money, built businesses, and trusted the system. You're the target. You're the ones who will absorb the bank's losses. So what do? How do you protect yourself? First, check your bank's commercial real estate exposure. Look at the bank's quarterly call report. It's public. Find the line for commercial real estate loans as a percentage of total capital. If it's over 200%, you're at a high-risk institution. Move your money. Second, distribute deposits across multiple banks, keeping each account under $250,000 to stay within FDIC coverage. Yes, it's inconvenient. Yes, you'll manage multiple accounts, but it's the only way to guarantee full insurance. Third, move excess cash out of banks entirely. If you have more than $250,000 you don't need immediately, don't keep it in a bank. Buy treasury bills directly through Treasury Direct. Treasury bills are backed by the U.S. government, not a bank. They cannot be bailed in. Or use a money market fund that holds only treasuries. Same protection. Fourth, if you're a business owner, establish multiple business accounts at different banks, each under $250,000. It's tedious, but it protects you. Consider keeping a portion of operating cash in short-term treasuries you can liquidate quickly if needed. Fifth, if you hold escrow or trust accounts, structure them as pass-through accounts where FDIC insurance applies per beneficiary, not per account. This can multiply your coverage. Consult an attorney on proper structuring. Sixth, do this now, don't wait. The commercial real estate maturity wall hits in 2026. We're already there. Defaults are starting. Bank failures could begin second or third quarter this year. You have maybe 6 months, maybe less. If you wait until the first failures hit the news, it's too late. Bank runs will have started. You won't get your money out. Outro and call to action. The bail-in framework is federal law. The FDIC has the authority. The banks are over-leveraged. The commercial real estate crisis is unfolding. When it breaks, deposits over $250,000 will be converted to equity in failing banks. It happened in Cyprus. The legal structure exists in America. It's going to happen here. You've been warned. The question is whether you act or whether you become one of the people on the news who lost everything and claims nobody told them this was possible. I just told you. The system is not designed to protect you. It's designed to protect itself. And when the choice is between your savings and the stability of the financial system, they will sacrifice your savings every time. That's not cynicism, that's policy. Written policy, published policy. They've told you exactly what they're going to do. They just used language technical enough that you wouldn't understand it. Now you understand it. Move your money, protect yourself. Because when the crisis comes, nobody's coming to save you. The FDIC will make insured depositors whole eventually. But if you're uninsured, you're on your own. And the crisis is not years away. It's months away. The clock is running. Act now.